Hello everyone and welcome to Jim Dalton's presentation for how to avoid overtrading. It's currently December 1st, 11:31 a.m. Eastern. We'll go till about 12:31 o'clock. We'll see how it goes. And for all you who are just signing on and the screen isn't showing anymore, please go to this webinar post at jdaltontrading.com to download 2 reports that will supplement this Mr. Dalton's presentation. It will be helpful to you beyond the slides. And that would be at Resources, Webinars, Upcoming Webinars, and click on for the top one, today's, and you'll see 2 download links there for the S&P Recap and Preparation Report and the S&P Morning Report for today. Okay, so that business done. Thank you everyone for being here. It's great to see you all. See a lot of names I haven't seen in a while, so thank you for coming out. And thank you, Mr. Dalton, for sharing your, I won't say how many years because I know you're sensitive, but thanks for sharing all your market wisdom with us. We're looking forward to it, and we've already gotten quite a few questions. So with that, thank you everyone for being here. This is being recorded. We will have it up at the site probably an hour after we stop the presentation. And if I may, I will introduce Mr. Jim Dalton.
Good morning, and thank you for joining us. As has happened to us before, sometimes we don't always stick with the schedule if the market may dictate something else. And so what I'm going to do, we have set slides talking about, how to avoid what are the biggest causes of overtrading. The second item on that is failure to recognize that price is simply an advertising mechanism. Some opportunities are accepted and some are rejected. And I'm going to start with that because I'm going to go directly now to today's market. And I want to show you what I'm talking about. We have an intensive coming up in January, starting I think it's about January 21st. 20th. Prior to the start of that intensive, we are offering what we call a continuation program. And the continuation program is for people that were in the last intensive and want to have continuity going into the January intensive, as well as for people that aren't as familiar with what we do, but want to get familiar prior to the January intensive. In that process, I'm making chat comments throughout the day. It's a one-way chat room, but it's all part of the package, part of the price, and the chat comment's an add-on, but I'm making comments throughout the day. And what I want to do now is I want to reflect upon the last couple of chat comments about a half an hour ago. Most people will, if they are not successful trading, it is generally can be tied to the fact that they are too influenced by price. Price is simply an advertising mechanism. Some advertisements are accepted, some are rejected, and of course there's all kind of room in between. The question becomes, how do you distinguish one price from another? If you look down at the low today, we had an early period low, A period low, we had an A period high. So we had a very wide range in the initial A period. Then B and C period initially traded inside. Finally, C period broke out to the downside below the A period low. The first chat that I put out, this was a poor low, meaning their C period touched A and bounced, meaning that there was no excess on this low or no signs of completion. So the first chat said it's a poor low. That's a signal to mean it's unlikely, or at least the odds are low, that that is going to be the low for the day. As you can see, C period then, after a small bounce, came back and took out the initial A period low. One of the things that we know that we talk about in the intensives all the time is the more difficulty a market has taking out a reference, the lower the odds that we're going to get, in this case, downside continuation. Doesn't mean it won't happen, but it just lowers the odds. And C period didn't come down and immediately go through A period. It came down, tagged it exactly, bounced, and finally came down and got through it. So that's one of those things that I record, that if you really had good, strong selling, you're probably not going to hesitate at that level. But we went further and we said, okay, if there is downside continuation, then you're more than likely going to get a double distribution day, and more than likely your point of control, or the longest line reading from left to right, will migrate lower. So then the next chat went out. At the time that we made the comment in the C period low, we were 3 wide at ABC, right? If you can see at the 2051 level, we were 3 wide, and then down below it was ACD and C, CD. Well, when C made the low, we were 3 wide right here at 2051. When C made the low, my chat comment said, if there is downside continuation, more than likely we will not, and I don't remember the exact words, but more than likely we will not go 4 wide at the ABCD at the 1051 level. And I said, if we did go 4 wide there, then the odds were that we weren't going to get much downside continuation right now. In other words, what we were looking at was structure. We were using the structure of the market profile along with our own personal observations to kind of assess the odds of downside continuation. And when we went 4 wide up here, we said that probably lowered the odds that we were going to get the downside continuation, which is what happened. Now, I know there's a lot of people out there that say, well, but why is that? The answer is, if you had a combination of long liquidation from people that had been long in the market and new money selling, more than likely you were going to get elongation as the market traded lower. When you went 4 wide at that level, the elongation the odds of elongation were greatly reduced. Additionally, when you go 4 wide there, that increases the odds that today's profile is going to look, at least the bottom portion of it, may look like the loop of the letter B. In other words, a long stem on top, followed by something resembling a letter B on the bottom. And what that is, it's an indication of liquidation versus an indication of new money selling and liquidation, or a combination of new money selling and of old business, which would be liquidation, and new money selling. Now, when the market rallied, if you look at the white line here, at 1254 even, that white line represents halfway back of this morning's profile. When you see a market go exactly to half back and stop, that's usually an indication that the selling that's taking place there is selling by weaker money, day time frame traders or short-term traders, but weaker hands going exactly or almost exactly to a reference level to be selling. Because one of the other things that becomes important to help you control your overtrading is understanding who is in charge of a market, who is dominating the market today. When I see the market go to exactly halfback and sell off, that's usually a pretty good indication to me that the selling that I'm seeing is day time frame or weaker hands money. So, I mean, it's just one of the things, but so like I said, I started off with the point that so many times when people are not getting the results that they want from their trading, it is because there is too much focus on price. When the focus is too heavily oriented towards price, it tends to make you very emotional. The more emotional you are, the less likely you are going to be able to make intelligent, calculated trading decisions. Once the higher the emotion gets, the more likely you're going to start to be in and out of the market, and the more likely you are going to overtrade. Now, I want to stop right at this point, Julia, and just take what we have addressed right here, just this short piece, and then let's take a couple of questions on that before we move forward.
Okay, thank you, Jim. Could you slide your chart down? Don't make it smaller, just slide it down so we can see all of today. There we go, great. Okay, can Jim explain why 6 wide on November 18th, B, C, D, E, F, G, and then elongate in H period?
I don't want to go back to November 18th. I want to handle what I'm
Well,
talking
I thought
about.
it was an example of elongation, but if you just want to revisit, when D went 4 wide, and you see it there if Jim points to it right there, 2051 level, even if the market was below there, you start cranking in odds. I don't know, Jeff, if that helps you with your question on November 18th. If we have time to get back there later, we will.
Any
Okay.
other questions just on what we're talking about today on this particular example?
Well, someone's asking, how would you trade this mess? I mean, the short off the open and then the failure to stay below the overnight low clearly was a long. The short going with the gap once it couldn't be filled is a gap rule. And where you take that off is obviously experience and trading style and your agility. But once it took out the overnight low and started coming back into that range, that's a signature trade of Jim's and what we're taught in the intensive. But if you want to address that, Jim.
Let's talk about, I'm going to go back for a second. And the first item, when I said the biggest causes of overtrading, number one was not being prepared. What has happened before influences the odds going forward. Now we're going to take a look at another specific example a little later on. But right now, again, what do I see going forward? If you look at today's report, and I think Julia told you how to get that report up, unless you're people that have already, part of the intensive or part of the continuation program, and have it. The number one and number two items on today's report were that the all-time auction high was made in the electronic market. We know from experience and from many times that we've talked about this, it is very unlikely that a long-term auction is going to terminate with an electronic, with a market making an electronic high. Second thing we covered, and let me go back and show you this a little more specifically. The 2075.75, I believe, was the electronic high made last Wednesday, and then we had another high in the no, wait a minute here, hold on. $20.74.75, maybe that's it. Maybe it's a couple ticks higher. Then we had the high on Thanksgiving, the electronic high on Thanksgiving. Now I'm going to not mark the pit session highs. So if you will look, here's a pit session high, and another pit session high over here. There was no excess on the pit session, high. Here's a high, there's a high right there. There's a high up Friday's high. There is no excess. So I'm coming in 2 items this morning. I have the all-time high being made in the electronic market. I have no excess on the all-time pit session high. It is very unlikely that a long-term auction will end in that manner. Now, stepping aside, one of the things that we're constantly talking about is that markets, like any business, have to handle current business first. Coming into this morning, we had weekend news. First, we had a downgrade of Japanese debt. Then we
Can you
had
put it back on the screen, Jim, just where we're looking at current prices? Thanks.
Okay. So we had a downgrading of Japanese debt. We had additional softness in some of the Chinese manufacturing numbers. We had an options end of month options expiration on Saturday, which some people are going to get long assignments. And when you get a market that has to deal with the current news of what happened in Japan, the downgrading, and some softness in China, that also can trigger some selling, some softness in the market this morning. So that may be the business at hand that the market has to deal with first. So when I come into this morning, we see the gap. We know the market's going to trade. We know the market's going to trade lower. And now, and we've got some more things to go over about this, but early on, here's the A period high, the open. We went a little bit through the open, and then the market single printed down. It wasn't all that fast. It hesitated for a while. Then it finally got down and filled a previous gap. It was down. It filled it overnight. It also went down and filled it in the pit session. That appeared to be mostly mechanical trading. When the market then re-entered, and we had a chat comment that the overnight low at 2052 was now upside resistance. That was upside resistance for short-term trading this morning. As the market re-entered, so you're talking about where do you go long? So when the market breaks this morning, if you're already prepared, the fact that more than likely we are seeing liquidation versus new money selling because we did not have a good high in either the electronic market or the pit session market, now you're saying what would indicate to me that I might want to be on the long side of that trade? And when the market re-enters the overnight low. Now, as it re-entered the overnight low and began to rally, we had 2 additional chat comments. So I'm trying to show you, how do you monitor for continuation? How do you monitor daytime frame trades? We said the next upside objective would be the opening, which was at the 2058 level. And we said following that would be the early morning high, which was at the 20, I got to move down the, which was at the 2060 level. So now you're sitting there and you're monitoring for continuation. We got through the opening, but once it got through the opening, the market was unable to take out the early morning high. Failure to take out the early morning high, and we didn't tweet it or we didn't chat it this time, but what we say so often, when you see this kind of volatility, if there's going to be a problem, it's going to be at this early morning high reference. This is the high odds place if there's going to be a problem. And once we didn't get through there, you're out of your long trade. Now you're sitting saying value is building lower. As the market starts to trade back down, the next target becomes the early morning low. It failed at the early morning high. the next target becomes the early morning low. So is it easy? No, it's not easy, but there are ways to monitor price in here. And then we said the final thing when we talked about earlier, when we went 4 wide, and then this last break, or the last rally, was just to a couple of ticks above half back. When I see the market go to a couple of ticks above half back, that is a day time frame reference. Longer term money has no idea where that trade is. So at that point in time, when it doesn't go through there, we get some additional short-term day time frame trade or selling, in my opinion. That's all we're seeing in here. Okay.
Yes.
Let's go ahead and take just another 1 or 2 questions before we move on.
Sure. Thank you, Jim. Can you just make your profile a little bit larger? If I'm hearing Jim correctly, he is addressing this B-shaped distribution, and this B typically represents day traders and less bigger hands traders, liquidating, not new business. Therefore, the trend is still up. The short-term traders are just taking care of current business. Would you agree with this assessment?
I see no change in the long-term or intermediate-term auction. The question revolves now around the short-term auction. The short-term auction, at least for right now, has turned down because we do have a gap, and once we gap, value is going to be lower today. So the short-term auction has turned down. We don't know at this point in time how much longevity, if any, it's going to have. But for right now, the short-term auction is down, and short-term auctions, they run from 1 to 3 days, sometimes a little bit longer in there. They start running, much over 5, 6, 7 days, then they start to, evolve into intermediate-term auctions. But right now, the short-term auction is down. We don't know how long-lived it's going to be. Right now, it appears to me that we are looking at a liquidating break relative to some exogenous events that occurred over the weekend. We don't see, so far today, we're not seeing any elongation on the downside that indicates to us anything more serious. Okay?
Yes, thank you, Jim. Jim, maybe you could slide over your chart more toward the price axis and just over so we can see the gap that was filled in, and make it just a little smaller just so we can, on my profiles, I'm able to see. Yeah, it doesn't have to be quite.
There's the gap. The gap was filled at
52.50. Yeah.
52.50.
But just you can, yeah, just. Well, yeah, okay. I'm able to show it all. I think you're showing your overnight profiles as well, so it's not letting us see the pit session.
Okay.
Just turn off the last week and just show today's overnight. That's it. Yesterday. Actually, you got to keep on yesterday, I think, Jim. I think that's considered yesterday now. Click, yeah. Okay. Jim, how do you factor in horizontal development at a major downside reference? And I assume, I'm not sure which Randall reference you're referring to. I assume it's the gap. Maybe you could shut your time templates too, Jim, so we can get free of that. How would you factor in horizontal development at a major downside reference like we're seeing now with the gap fill?
Well, I'm not sure, I think, in terms of horizontal development. I think that's a term that, although I tend to look at markets horizontally, but what you're looking at, this is the prior trading range runs up here from the 1050. I've got my GoToMeeting icon is in the way a little bit, so it's hard for me to get exactly on the price. Okay, 1054 represents the high of the previous trading range. So, and we're back in that range right now. So this is a very difficult go, no-go level, and to use your term, horizontal development. If in fact, as we look at today, remember the market is a continuous two-way auction process. So early on, we looked and we said, if we get 4 wide down here, we're probably going to rotate higher, or the market may have gotten too short. But now, as time has gone on, remember, one of the other chat comments out there was to be sure to monitor the point of control. So right now, the point of control, which is the longest line closest to the center of the range, the point of control is right up here at the halfway mark. That point of control can change. The time in the lower right-hand corner, it is 11:56 Eastern Time. We're going to change time frames here very quickly. So the point of control can go lower right now. If the point of control goes lower, then we are getting more acceptance down below the gap and back within this prior trading range. And that prior trading range, extends all the way down to the 2035 level, or even more important, down to that low down there is about the 2035, 2036 level. So we don't know how this is going to turn out today before it's over, but we do monitor the point of control for downside continuation. So if in fact the point of control widens out here, then we are getting more acceptance, or I think your terms would be more horizontal development down at this level. So we'll continue to monitor this. So right now the attempted direction is down, value is lower, and there's a potential that the point of control will rotate lower as we change time periods in about 3 minutes. Okay, what I want to do.
Okay.
Go ahead, Julie.
A quick question. The one time framing lower, we have been one time framing lower with the exception of E period. How should that be observed? Just so we can stick with this auction. Slide it down a little, Jim, so we can and make it a little larger so we can see it a little more clearly.
I don't see one time framing lower. I mean, I understand what you're talking about, other than E period. What I see is more balance. And that doesn't mean I'm right. I'm seeing more balance in here. And I'm going to watch the point of control fairly carefully in here. But I see balance, but I'm not going to argue with you if somebody says they see one time framing lower. That may well be the case. I see short-term balance, but that can happen very easily. Okay, what I want to do next, because remember, the purpose of this is to talk about how do you keep from overtrading.
Can you show your chart all the way, Jim, your profile for today? Excuse me.
Okay. So one of the questions, and one of the things that we find is people that have trouble trading have a tendency not to be able to determine when to trade early and when to trade late. And one of the things that I find, if I open up within about the center of yesterday's range, then I have more of a tendency to say, I'm not going to trade early. I'm going to let the market shake out. I want to see what I'm dealing with first. When the market opens out of balance, that's usually an indication, either out of balance or at the edge of the previous day's range. That's usually an indication that the odds for something more significant happening today are higher. And when the odds of something more significantly happening are higher, you may in that case want to trade, early. But that's a distinction. I think there's an awful lot, in everything I've read and people I've talked to, there's a tremendous amount of money lost from people that trade too early in the day. And I'm not saying, some people say, I'll never trade early. I'm not saying that. I'm saying be more discreet. A lot of times people come in and they're so excited about trading, they can't wait for the market to open, and then they have the tension, oh my golly, what's it going to go? Is it go up? Is it going to go down? I've got to get in here early. I don't want to miss the biggest trade of the day. Once those emotions start cranking through, and once you start looking too hard where you want to trade, the odds are pretty good that you're going to make an emotional trade, and you're really not, it's going to be based on price, and you're really not going to have a real good opportunity to have a thoughtful trade. So this idea of self-control, and determining when you trade early and when not to trade early is usually very important. If you trade early and you lose money early on, it tends to set up this competitive nature within you, and this competitive nature, they're going to get that money back no matter what. And that's when you start over trading very, very quickly in the market. And then, you know, adrenaline goes, one thing leads to another, and leads to another, etc. And the day is ruined. You get too tense psychologically, you lose money, and when you lose money, sometimes you have a tendency to continue to do bad trades. So there's so much work that shows, you see people that, you know, staying out of temptation, people just staying out of the atmosphere that gets them tempted or bad behavior has a tremendous value to it. If you make up your mind that you're not going to trade early unless you see a level of confidence, unless you see a level of confidence, not based on emotion, but you see something really developing in the marketplace. So I think it's a huge issue out there. Okay, before I want to go to an example that we have to work with today, one of the other things, well, look at the current market. We've changed time periods 2 minutes ago. We're going to watch very closely and to see what happens with today's point of control, because we know at this point of control time, the point of control can migrate lower. Right now, the point of control is at 2051, I think that's 2051.75. Previously, the point of control was right up here at the halfway back at 2054. So the question is going to be, does the point of control rotate lower as the day goes on? Okay, what I want to do, I want to go back and I want to use Friday as an example. I'm going to split Friday out. Oh, where's he?
That's it, Jim. Market profile, expand profile. You had it.
Oh, do they have it?
Expand profile.
Oh, there it is. I'm also going to tell you that the D period high on Friday was also the overnight high. Overnight inventory, by the time we opened on Friday, overnight inventory was short. We know that there's about a 65% probability that the market will give us a counter auction relative to overnight inventory. When you look at Friday, the market, hold on one second. Looked at Friday, the market opened, traded lower, and then began to trade higher. Before we go to the next step, if you may recall earlier, I said one of the most important things to control over trading is preparation. If you look at the report that we sent out for Friday morning, and the low, the overnight low.
They don't have that report, Jim.
Okay.
Thanks.
I'm sorry. Thank you. The overnight low going into Wednesday was exactly the same price that turned out to be the low for Wednesday. Additionally, Wednesday was a poor low, which meant that there was no excess or buying tail on the low. That report had written on it, stops at this level. So what we're looking at is the potential for stops down here. Almost every time I have written on a report and signaled out the potential level for stops, those stops have gotten hit. Just some luck involved. Now, the overnight low, going at Thursday overnight low, was just a couple of ticks above this low. So what I did, I said that the overnight low from Tuesday, Wednesday's low, and the Thursday overnight low were all very close to each other. So that increased the odds that there would be game playing that would go after those stops. Additionally, the early low on Friday morning was very close to that. So if you take the overnight low from Tuesday, Wednesday's low, the overnight low from Thursday, and the low from Friday morning, and we call Friday morning a dynamic low because it developed on the spot, within a point and a half, you have 4 previous lows. Well, that may hold, you don't know. But you want to record that, and you want to know what kind of conditions do you have underneath the market. Now, the market traded up from the A period. A, B, C, D, E period. One of the things that you're always looking for is you're saying, what is the market trying to do, and how good a job is it doing of what is it attempting to do? So the market on Friday was attempting to trade higher. B period fell short of the overnight high, fell short of the pit session high from Tuesday, or matched just one short of Wednesday. C period fell short of taking those highs, and D period came up and took the tagged the exact overnight high. So now you've been 1, 2, 3, 4, 2 hours with the market trying to go higher. Another thing that we talk about continually in the intensives and in the chat is who is trading, who is buying this market on Friday morning. When I look and I see that the opening was at 2069.25, and I see that the B period low was at 2069.50, that is a pretty good indication to me that who is buying this market are the day time frame laggard weak longs. Simply going with the trend, buying any small pullback. The more, every time the market pulled back, they bought it again, they bought it again. Finally, you got a decent high up here. Now, my question to all of you is, if you were trading and buying this market on Friday, buying these little dips on Friday, you were a laggard buyer. You were what would be considered a day time frame, weak hands, laggard buyer. Reference being exactly 1 tick above the opening. Long-term money or stronger money has no idea what 1 tick above the opening is. So one of the things that will always help to keep us from overtrading is understand who we are competing against. So when I look at Friday morning, I say I am competing against day time frame weaker hands. Now, the longer this goes that you can't get through this level, and Julia used the word yesterday we were talking to someone, this is more confirmation that there was no real underlying strong buying in that market. So what is happening up here is this inventory is getting longer and longer and longer. So the market got short overnight, we got short covering, then the market spending 2 hours up here cannot get the high. When a market can't go a single tick above the overnight high, there certainly isn't much strength there. Then, so you look at that, if you're long and wishful thinking up here, it's a really bad it's a really bad trade. And it's a really bad trade from the point of view that your risk reward is so limited on the upside. This, if there's going to be a problem, it's going to be getting through these old highs. Now, then what happened, once this failed up here, you had this high, we came back down through the opening in F period, and now all the market did was go back down and get all these stops that we previously mentioned. So we put on the chat room, we said, there's a point in time, at one time the low was poor, we said it's a poor low, we came down and took it out, but we said once we got through the 20, I think it was 2065, 25 level, which were the last of the stops, you went down, it triggered those stops, that was it. That was game over, side out. All you had, so understanding what was going on a day like Friday is understanding who you're competing against, understanding that the smarter, shorter-term traders that have large pools of money understood the market conditions, understood what we had labeled coming into the morning, and they went back and they took advantage of traders later in the afternoon and forced them out and made a lot of money. And that's all. It was just a game. It was just a game. But I want you to understand that when you're talking about controlling your trading, you need to understand what is the market trying to do, how good a job is it doing at what it's trying to do, and who are you competing against. If you are long with the day time frame long traders, you're doing what the shortest term traders are doing. The next longer time frame, the short term traders, they're just sitting there waiting to take advantage of that. So I mean, it's an interesting day because there's so much, even though it was a nothing day overall, there is so much to be learned from a day like Friday that happened in slow motion to help you have an understanding of what's going on in the market and how do you keep from overtrading. If you're buying every dip like this on Friday, you're overtrading. And the odds are it's just not a worthwhile trade. Anyhow, and then once it took out the stops, once they those short-term traders that have a lot of money took out the stops, that was it. The game was over. Okay. Questions about what we talked about and just what happened on Friday. And incidentally, you've got the slides. There's more detail on the slides for you to be able to analyze after the webinar is over.
Okay, I didn't upload the slides, but everyone, I'll get those uploaded on. You can get them at the same place you got the reports, at the webinar post. Jim, one just elaboration on what you were talking about. When the market was, was pushing higher very slowly, it got heavy. We had 2 hours of just trying so hard to get out Thanksgiving's high and tapping the overnight high to the tick. You had said the short-term and day traders that were following price and doing what everyone else does or was doing, they were buying. But the next higher time frame, isn't it fair to say the smarter money, or at least yes, the next higher time frame, were the ones selling to them? Like you bought some, you bought some more.
That's right. It's still the shorter time frame, but the shorter time frame is they're going to be other than the day time frame, but they have huge amounts of money out there, huge amounts of money, and they can muscle a market, and they love to muscle markets, particularly on days like Friday.
With low liquidity and.
But you could have, so there could have been some short-term money buying as well as selling, but the smarter, as you phrase it so well, the smarter short-term money was doing exactly what you're saying. They were selling early, very quietly. Every time it got up there, they were laying into the market, as you said, very nice. They bought some, and then as the day got on, and the daytime frame traders got longer and longer and longer, then the rout was on. But if you were prepared ahead of time, as I say, and it's doable because you say we had identified that area. It was on the report, so it was pre-identified. So when I'm going into Friday, my imagination can do a pretty good job of saying what can happen. Now, do I think Friday, do I think there's any indication that the long-term high was over? That the long-term highs are in and completed? No, I don't. I think that's pretty low odds. But for Friday, when it couldn't get through there, once it couldn't get through there on Friday, when that didn't happen, then you've got a pretty good indication that the market's getting too long, and watch out. It's a continuous two-way auction process. You fail going up, then you come down, then you're going to get a reversal in the auction. Now, the question becomes, one of the things that we talked about earlier is how do you keep from overtrading? You keep from overtrading by having a place for a structural stop. A lot of people make the mistake of saying, okay, I only risk 2 handles or 3 handles on this trade. That is a very bad way to go. You need to have some identifiable reference. So when I'm looking at this, if I want to short this market on Friday, I'm going to have my stop someplace up above the overnight high. I'm going to have my stop someplace up above here. So it's got to violate the structure. It's got to violate the structure before I'm taken out of that trade. And as you see, when the market comes back down, okay, it was an asymmetric opportunity. Now, how do you exit that trade? Well, I made a determination down here, and I said, remember, I had a poor low on Wednesday. Tuesday's overnight low was exactly the same. Thursday's overnight low was just a couple of ticks short of this, and Friday's early morning low, there was in 4 lows within 1.5 points of each other. Once they took that off, and I was already fairly fat up here, I didn't have a particularly good high, I'm just going to exit the trade. I'm going to exit the trade because, again, I had a structural place. So what you do, you could exit here because it was late in the day, or you can exit once it comes back in above this structural level. So you had a couple of places, to use structure to guide your trading. Another way you could have traded this market on Friday is once F period came back below the B, C, D, E lows, and remember we had focused on this opening. Once you came back through there, something's changed, you're out of balance. The 2 most important concepts we ever deal with in trading are excess and balance. There was another chat that went out, and the chat went out once we got down through here. Well, it's a couple of chats, very important chats, because on this break, twice we had poor lows, meaning that F and G tagged each other, or A and G tagged it. So there was no excess on the low. Went down, it bounced again, leaving a poor low. Did that twice, and then finally, once it got through here, the next chat said, okay, is that the end of it? We went down and got the stops. That was the game. Game over, side out type of thing. But it's part of trading is really understanding the gamesmanship that goes on. It will help you tremendously. Trying to understand the market just in terms of numbers, in terms of price, is very difficult. Let me give you another example, and then we'll open this up for some questions. This morning, this is overnight inventory. Technically, we would define overnight inventory as short. This was Friday's settle, so we say that any trading that takes place below Friday's settle would be short. Okay? That's a technical definition. But now I'm going to split out the overnight inventory. And so we broke early. We rallied, we broke again, but then from the lows down in here, we rallied for 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10 periods up here. So we rallied up here. So what I wrote this morning, was, and I forget the exact words, but I said, I think the words were, overnight inventory is either neutral or potentially long. Now that doesn't fit the definition, But everything we do in the market, we have to be intelligent and we have to view it in terms of context. So about the time we opened in Europe, the market's higher, so the chances were pretty good that inventory from overnight traders, which are weaker traders, got long. And then, of course, we got the liquidation early this morning. So again, one of the things that we're trying to do, trading is not easy. Trading is not easy at all, and there's a lot of motion on it. One of the things we're trying to do with the chat, with the intensive, is be as close to mentoring you and give you things to focus on that will allow you to continue to build your understanding of the market. The stronger your market understanding becomes, the less likely you are to overtrade. Okay, let's open for questions, but what I want to do is I want to come back, and just before we open for questions, I want to go back and let's update where we are right now. I'm going to take some of these lines out of here for right now. Okay.
Slide that down so we can see the whole day, Jim. It's just easier.
Okay.
Thanks.
So now, when we started to talk about the other things, we were talking about the potential for the point of control to migrate lower. Somebody asked the question about horizontal development, and meaning, getting value accepted lower. So we were looking very hard. So if there's much more on the downside, then more than likely the point of control rotates lower. At the time, we said the point of control was right at halfback, and that halfback was at 1054.
It was about 2054, yeah.
Okay, 2054. But we also commented, and these are the nuances, and nuances matter. We said when the selling came from just a couple of ticks above half back, that is more than likely an indication that the selling is taking place by weaker hand traders rather than longer term money. And why is that important? Because usually to drive a market substantially lower, you need a combination of liquidation by shorter term money as well as being joined by longer term selling. So when we make this nuance that the selling came from exactly half back, that lowers the odds that you're going to get much more on the downside. Additionally, we said in here that the market did not elongate. We had a chance, if we could have lowered the point of control down here, we had a chance to elongate. We didn't elongate. So more than likely, when I'm looking at today, I'm looking at, short-term liquidation, some enthusiasm from, people saw that some of the overnight news was on the soft side or negative, but we're not getting that elongation down here. So you could have easily gotten trapped in, once again, to following price down here. Because I knew who was doing here, yeah, it could go lower, but I wasn't interested in following that because the odds don't seem high enough. And I want the odds to be in my favor. Go ahead, Julia.
I beg your pardon, sir. I just wanted to make the comment. We do have traders and pretty agile day traders that would take that short off of the halfback or a few ticks past it, but they have the awareness to not be married to it and expect the big trade, as we say, from it. And it also you would also say, I think, that goes with the lack of elongation in the structure of the profile, that if the market were truly weak and we were one time framing lower, the market wouldn't come back to halfback to play that game, correct? I mean, bigger
Right.
money that had some size to press on this market, they would have been selling into it well below half back and kept pushing it lower,
Yes.
correct?
Let me clarify something. When I was talking about not taking this short, I wasn't talking about not taking this short. I was talking about when we opened down here and we started to widen down, it looked like you were getting a little pressure of price on the downside. Down here, and you say, oh, the point of control could rotate lower. That's the trade that I would not do. That's the trade I would not do, because if I do it, if I go short down here, And yeah, it was starting to feel that way a little bit. I mean, price was lower. They were pushing
Point
it
of
lower.
control migrating lower.
Could migrate
for
lower.
a couple of minutes. Yeah.
That's an easy place to get emotionally involved and say, I got to get short this market. This market's going. Boy, this thing's really going to go. Boy, we're back in the prior range. This thing could go all the way down to the 35 level. And you can get very emotional and get into that trade. That is a trade that I would not do. And the reason I wouldn't do it, because the selling's coming here from exactly halfback.
Couple of ticks, yeah.
Couple of ticks above halfback. So it's probably fairly mechanical. I had a chance to elongate earlier in the day, and then I develop an attitude. This keeps me from overtrading. I develop an attitude. If I miss a trade, so what? If you really want to mess up your trading, be afraid to miss a trade. If you want to be a good trader, be very willing to miss a trade and say, so what? And let it go. Julia can tell you, she's traded with me enough. She knows it. You can be very philosophical. If it doesn't line up my way, I don't want to do it. Once you get that fear that I've got to trade, I don't want to miss this trade, it's going to be pretty difficult to be rational about the trading that you are doing. Okay, now we can still go lower today. We're now at 10:27. So it's 12:27 your time or Eastern time. So we can still lower the point of control. But even if we lower the point of control now, it's still going to look fairly close like the letter B. So we're still going to look pretty close like liquidation rather than some new combination. Now, we do have a gap. So, again, it's a continuous two-way auction process. We do have a gap today. So we have to be very cautious. But right now, I'm focusing on day time frame trading because that's what most of the people we deal with are. Okay, let's open it up for some questions, Julia.
Yes, and just a theme on the overtrading. You've commented, I remember in the last intensive, that really are written about the sign of mature trading, being a mature trader or maturity is being able to see a trade, yeah, it might go lower, but you have that discipline or that awareness to pass because the odds in filtering out expectation, you're confident or have the security to just let it go. That it's a sign of trading maturity when you don't have to engage in every opportunity that comes upon you. You can filter through that, and when you start stripping it out, you say, yeah, it might go a little lower, but it's not for me. The risk doesn't warrant engaging the market.
Yeah, or all the factors don't line up that I really would like to see. One of the other things that we that are on our list in there, it's on one of your slides, that talks about how to stay out of overtrading, is recognizing when markets are too long or too short. Now, today, I don't know if today's market's going to turn out to be too short or not before the day is over, but the lack of elongation in here. What do you have traders doing right now? Right now, traders are selling every little bounce. Like Monday or Friday, they were buying every little break. Today, they are selling every little bounce. We got up there to half back. They sold it. The F period came just within a couple of ticks from half back. They were selling it again. So this is a market that has the potential to be getting too short. Now, that doesn't mean that the market's not going to go lower because, I mean, there's still a lot of weak longs in this market. But from an odds standpoint, there's a pretty good shot that this market's getting very short in here. Now, that can go on for more than one day. That can go on for more than a day. But it's just one of those things to say, well, no matter, even if we do extend lower and bring the point of control down today, the market appears to be getting too short. And I just say, I don't want to play. I don't want to be caught in it. The risk-reward isn't worth it to me. But so when it's too long or too short, another thing, when I said this morning, if we got 4 wide at that one level, if the market traded down from that, it would leave an anomaly. When you see anomalies, which are jagged edges on the profiles, that's also usually an indication that the market is getting overextended in the direction in which the anomalies are left. For example, if the market stopped right here, right now, this would be an anomaly. It's kind of seeing a jagged edge. If the market's going down, it would say wider here, wider here, wider here. It's going down, but it's leaving an anomaly. That's usually a sign the market's would be getting too short. Okay, other questions there, Julia?
Yes, thank you, Jim. And also, now we're really starting to widen out. We're 7 wide, so that makes it more difficult for elongation, correct, to take place. Or at least, let's just say it this way, a 45 line could potentially be forming here. It comes up, it goes back down. It comes up, prints another print wider in the middle of the profile, widens out the point of control, it starts trying to go lower again. So that up, and that's part of one of the signature trades on the worksheet of the 45 line forming. And a market that is getting too short. They keep selling it every time it comes up, but they're not getting much for it. And eventually it doesn't work out and it comes back through and you have a short covering rally take place. I mean, do you see this as a 45 line formation or potentially forming?
Let me put this in another the same thing that you said. But so if you take the point of control right here and you draw a line down to the base, you start to see that it's kind of looking like a 45-degree line. And what Julia is saying is the market keeps trading lower, but it keeps coming back to the point of control. In order to make this more understandable, a better word, rather than point of control, a better word is to think of the point of control as the fairest price at which business is being conducted. So if the fairest price at which business is being conducted is up here, but yet the market trades down here, bounces, trades down here, bounces, people are getting short in the hole. In other words, they are selling at prices below the fairest price of the day, selling below value. That is a typical definition of getting short in the hole. Now, that opposite thing can happen on the upside too. When you take a look today at how wide we are, I think Julia just said we're 7 wide here, okay, it's going to be difficult for the market to make much progress either up or down from here because the fairest price to conduct business is now 7 wide. Price advertises opportunity, time regulates all opportunity, and volume measures the success or failure of the advertised opportunity. The point of control is a time element. It only gets wider over time. So in other words, you know, to bring this point of control up right now would be very hard. Easier to take it lower than it is take it higher. But if we start rallying and then come back down, get some short covering rallies, come back down, we could just as easily, before the day is over, develop a 45-degree line from the POC, or fairest price to do business, to the highs. And not that it's going to, but I want you to open your imagination so you have a better shot to understand. When you look at the market, you want to understand, what are most traders doing? Are they getting short in the hole? Are they getting long at prices above fair value? You know, being the point of control. So it's this constant, continuous two-way auction market. But once you get in the flow of the market, you start to get a feel of what some of the traders are doing. And one of the things that we emphasize continually is our goal is to teach you to trade via understanding the behavior of the people you are competing against. When I showed Friday's example, the big opportunity came in the afternoon when you understood the behavior of the people that you are competing against. They got too long. As the day went on, they got flushed out of those longs. So not only did they get flushed out of those longs, but other traders jump on top and start selling. When those traders get caught long, smarter traders also jump on top and press the market, knowing that they've got them in trouble and knowing they're going to just force them to sell more and more and more until it went down and took out those lows. And at that point in time, the game was over. So it's important to understand who you're competing against, what time frames, what are the inventory conditions in the market. The shorter term trader you are, the more important it is to understand day time frame inventory in there. And so many times you'll see constant rotation and adjustment of day time frame inventory on a day time frame trade. Traders get too long, they go the opposite, they get too short. They get too short, they rally, they get too long. We'll see that happen 3 or 4 times on some days. And you need to be inside the flow of the market to say what is going on. Okay, additional questions, Julia?
Thank you, sir. Yes. This makes so much sense forensically. However, when the market jumps around and, is just having typical S&P price action, it's much more difficult to see and comprehend. Is this me looking too much at price again?
Yes. Yes. And that's what happens. See, price, you have to be able to look beyond price. And one of the things, let me give you some background. One of the reasons that and some of you have heard this before, but one of the reasons that we're talking so strongly about the importance of the continuation program, where you get the chats every day, you get the reports, as well as the January intensive, is it really is a result of first observation by Julia. We would go out and we would do a seminar in a hotel. And you might have a great hotel room and, you may get lucky and have some great trades. One of the ones we talk about all the time, the last live market seminar that we did, it's recorded, it's for sale, came in the morning and we identified the possibility that the market might be too short, it might open weak and close strong. We got very lucky. As the seminar ended, we get a 400-point rally in the last 40 or 50 minutes of the market. And so I said, boy, wasn't that a great seminar? Actually, it was a very little value to people on a longer-term basis. Was it great for a hotel room? Was it a great way to end the seminar and people clapping and everything else? It was fun. But really, when you say to take away all that value, you're only seeing a couple of different days. When Julia started to question that, then we came up with the idea of the intensive. And the first intensive we did was 60 days. So over 60 days, you get to see more and more different situations. The more situations you see, the more you get yourself prepared to be able to trade in any kind of market. People sometimes will tell you, well, you got to figure out what you do best, and that's where you trade. And I really don't buy that, because markets aren't that accommodating. If you're going to be a full-time trader, then you have to understand the market in its present tense, and you have to adjust to the market. The market's not going to adjust to you. So we did the 60 days. And so, in other words, and over that period of time, and these intensives the same, was 8.5 to 9 hours of our being live with you throughout the week. We were doing some kind of webinar almost every day. It was doing the reports and continually trying to stay in touch. Well, the 60-day, it was actually just too much. It was too much for me. So what we did, the next shift, was to a 30-day intensive. However, then we got really live with the chat. And I believe, in my opinion, that the chat, the comments I make on the chat box, the one-way chat throughout the day, are really most important place of where you are going to solidify the comments and what trading is really all about. Because it allows us to piece it out and say, look at this, look at this, look at that, look at this. And I think that gives more continuity to be able to continually have the chat box open. And when we first had the chat box, I wasn't there all day. I'd go out and I'd do my bike ride or do my exercise. And then now we've evolved to the point where, unless I have a doctor's appointment or something like that, or someplace I have to be, we are live with the chat from the time the market opens until the market closes. And I think that's really where we're able to continually impart real value. And the clue is, as somebody just asked the question, you get this price going around, you know, and it gets harder to know when to get in and when to get out. Part of it is being able to see it on a consistent basis, so you internalize the information. So you get a time to internalize the information, meaning it becomes you. It becomes you, not me. You're taking it, you're seeing it over and over again, and somebody's kind of guiding you along. And sometimes I'm not always right. I'm not always right, but there's usually some reason behind it. As we pointed out here today, we looked at the halfback. We said, okay, who trades from halfback? More than likely, that's going to be weaker traders, to go exactly to that. So it tells me, who am I dealing with today? I'm probably dealing with short-term traders. What are short-term traders doing? They're probably trying to sell out a little rally. Is there potential for them to get shorter and shorter? Yes, there is. Does it have to clarify itself today? No, it might be later. But as this goes on, now as we get wider and wider here, we say, well, guess what? There's less and less chance that we're going to get a sustainable rally out of here this afternoon. Can we get a short covering rally? Sure. But the wider this gets, the more the odds increase that tomorrow's going to look, this is going to be kind of a balanced day with a gap above it. And, you know, we're going to have a prior trading range down below it. So it's going to be a lot more, if we continue about where we're going today, it could be a lot more uncertain coming into tomorrow about what are we really dealing with here. Okay, so now what are we looking at? The market is, somebody earlier talked about one time framing lower other than one period, and I said it may be. I said what I saw was more balanced, just more sideways, and what we're doing, we're moving sideways, but now we got to be very careful because we got the EFG, so balance is getting tighter and tighter and tighter. The tighter the balance, the higher the risk that you could get some breakout trade either up or down from that balance. Again, just the little nuances you go through the day. Did the point of control lower? Yes, the point of control lowered. It was up at 2054. The point of control is now at 2053.25. Did the point of control lower? Yes, it did. Could it lower again? Yes, it could. Additional questions, Julia?
Yes, sir. Thank you. And this gentleman, he seems like he's probably a little longer-term trader, or his perspective, but he's saying with no aggressive buying and horizontal development at the bottom of the gap, and he's talking about the gap, we can't see it on your charts. If you slide your profiles over, Jim, I think you should cancel, if you go up to that day you were looking at on Friday, you can cancel out that split you put there, Jim. And that'll compress your profiles. We'll just cancel that out. And anyway, the gap from November 21st, he's saying with no lift off where we're at here, and we are, you know, developing balance in the gap, is that not a higher probability that we are going lower?
Not necessarily.
Could you shut your time templates too, Jim? Excuse me.
Let's take the pieces. The long-term auction remains up. There is no high there is no high, no excess on those highs. The long-term auction up, the intermediate auction remains up, at least for now. The short-term auction is down because of the gap today. So now when I look at it, I'm saying, okay, I don't have any indication that I have completion of the longer-term auction. But now on the other side, I'm getting acceptance down below the gap, and I'm getting acceptance back within this prior trading range. So you can say, well, without much lift, aren't the odds that we're going lower? And certainly it's got my attention. Certainly got my attention. But what does it take to really put it lower? It takes selling. And what I haven't seen today, I haven't seen real selling. So I wouldn't make a major bet on the next 20 handles being up or down from here. You could see it go down, you could see it go up on the next 20 handles. There's a lot of things going on in the world. There's a lot of a lot of news out there going on. But right now, I would say that it's you can easily make a case for lower. You can easily make a case for higher. where we get in trouble sometimes, is we get pretty adamant about where the market's going, and the cognitive dissonance sets in. And I can argue, I would be willing to go in a debate and argue for the market to rally from here. I would just as easily be able to go in the debate and argue for the market to break lower from here. I think it's a toss-up. Right now, the pressure's to the downside based on the gap today, but we're not getting a selling, we're not getting elongation. I don't know, I haven't checked the volume for a while, but the attempted direction is down today. And who's the Billy Bob, I don't know if you're out there. I know you had surgery last week. I don't know if you've recovered enough from your surgery to be joining us. I hope you have. If you are out there, what's the volume look like it's going to be before the day is over? Can you see if Billy Bob
Jim,
is on with us or not?
I don't know if he is, Jim. I'll check in a second, but on the training site, it's still at the Yahoo site. It's 1.9 billion today, as opposed to Friday was 2.5 billion. So the volume is lower, given the 12:30 Eastern hour versus, last week. So it's, it was 2.7 on Thanksgiving, so you can tell
it could be Friday could be a little difficult to compare because it was an end of the month option expiration, which sometimes will be
higher,
a little higher. But unless your volume today on the downside shows someplace in the area of 3.6, 3.7, when the day is over, there's no real sign that you're getting significant selling in here. So anyhow, but I said my point is I understand where your thinking is, and I could easily see that. I could easily see a rally. If we saw a rally, I would be looking for that rally to be completed, because we have done damage to the downside by closing the gap and finding acceptance back within this prior trading range. We have certainly done damage to the downside. So it has weakened the market overall, but the big thing I'm facing was I don't have the completion to the long-term auction. Doesn't have to have it. Sometimes the market will break, sometimes significantly, and eventually come back and take it. But I think personally I'm neutral from here. Okay. A couple more questions.
Yeah, in the CQG, Jim, do you have your bar charts up? Because we are inside that daily bracket or that daily trading range. If you were looking at a daily bar.
I don't. I've got CQG on the other, on the other machine today, so I'm following other markets. But yeah, we are clearly back down in here. We are clearly back down in this trading range. If you look at the bar charts, and other negative things, we are clearly below. We've got a downside breakout below the 4-day balance and below last week's low. So right now our short-term auction is to the downside, and I don't it's clearly to the downside. We have a downside breakout, and we've gone back. We've corrected this very prominent point of control from going back from the 20th. We've corrected that. Now we're here. Somebody had a question earlier about the 18th. And now that we're back at the 18th, can you recall, or can that person remind us what that question was?
He was curious about the, it was like 7 wide. H period broke out of it. So if you go back the 18th and you split it, well, actually, see how H broke to the upside? We were wide A, B, C, D, E, F, G, and H. I guess it wasn't so much G broke out too. It was the market's been doing this where it's been creeping higher or slowly oozing lower. It's just this stealth-like action. Never a lot that makes you, if you're not already in it, you're not compelled to necessarily go with. But he was asking about the H period breakout and how you would observe it, how you would interpret it.
The market was just one time framing. You put a low in C period. You had you had I think the market started out short overnight, and you just started to one from C period, one time frame. When I look at this, E within a tick of D, F within 2 ticks of E, G within 2 ticks of F. It's a fairly weak market, but again, it's not completed. It does lower the odds of upside continuation, but you got the final short covering up here, but then you got the break all the way back down to here. So even though it finally ran up to here, left a poor high, the liquidating break, how this market was struggling going higher and how wide it was reducing the odds of much upside continuation and follow through. And you squeezed the market, you got the short squeezed, but then you got the liquidation break. So, I mean, they have been very difficult markets, and part of the reason they've been so difficult, the difficulty is that there's no conviction on either side. The markets continue higher because that's the trend, and there is no longer-term selling has come out of the woodwork. No longer-term selling has appeared. So the market's following the trend. It's just following the trend, and it's following the momentum. But it's certainly not, in my opinion, it is certainly not a strong market on the upside. We got in a debate yesterday. Somebody called the market strong. I said, I don't grant you that the market is strong on the upside. This was yesterday morning. I said, I will grant you that the momentum is taking the market higher. I will not grant you that it's a strong market. As evidenced by when we're looking down here at very prominent points of control and the prominent point of control here that hasn't been revisited, we know that limits the odds of upside continuation. Did the market squeeze higher? Yeah, because that's what it's doing. And part of that is very artificial. As we pointed out in an article we wrote last week, that in one period of time, the world sees a stronger dollar as being negative for stocks, and it makes us less competitive. Well, it makes us, it pressures the big blue chip companies and the multinationals, but it's not so bad for the smaller companies, because what happens when foreigners are investing in our market, they get the benefit. They convert their currencies to dollar when the dollar is strong, and it's been up near highs going back to 2010. When the market's strong, you know, you make a little money on the currency conversion. So that's been favorable. It's helped our bonds. And I think it's helped our stock. But again, some of that is very unusual to what's going on in the market. You know, you had downgrade in Japan. You had weaker numbers, you know, in China last night. So some of the money's coming here from default and because of our dollar. But I don't think the market overall is strong. I think it's a very risky market. Okay, let's take 2 more questions.
Yes, can you comment on the fact that we've stopped one time framing higher on the weekly bar?
Yeah, I mean, it's an indication. We gapped lower below last week's low. It is an indication. It is an indication that that some change has occurred. So yeah, no, it's absolutely something I notice all the time. And but the other side, I'm saying, when you gap lower, when you look at all the pieces, we didn't get that elongation today. We didn't get that. You know, they really could have taken this market apart. You had all kind of negative overseas news. They could have taken this market apart. They didn't. We could have had elongation. We didn't have it. We could have had increasing volume on the downside. We didn't get it. I suspect that the market had to take care of current business first. You know, and that current business was some liquidation in it. There's been a lot of weak longs, a lot of people blindly buying this market. But I didn't see any sign today of longer-term money coming out of the woodwork and, you know, and selling into the market. It's a strange market. You had gold down $25 overnight. It's now up $36. You know, you had crude oil down. It's now up $241. You had bonds up. Bonds are now down. I mean, it's a very, very strange market. But I'm going to go back and I'm going to say the piece of information that is most prevalent in my mind is I have not seen any completion to the longer-term auction. It doesn't look like it's over to me. Does that mean I like the long-term auction? No, I don't like the long-term auction. But I have not seen completion to it. And as we have written on several reports, until there's some clear completion, that all of a sudden investors and traders say, wow, that looked like a high, and their thinking changes, and that thinking can change very, very quickly. It's amazing. All of a sudden, if it looked like there was a high, that thinking can change very quickly. Today, they could have gapped lower and seen a change in thinking. We didn't see it. Now, we'll see what happens as time goes on.
Jim, okay, yes, one last question. There is a P shape, if you can show November 20th, and today is shaping up to be the B shape. Since there is, and there are anomalies in single prints on November 20th, would it be reasonable to target the bottom of those single prints from the 20th if the market starts to break down today? So getting down toward, can we lean on that structure from the P shape? Can you slide it over, Jim, to the right so we can see both days without touching the size? May as well show it since you're not, yeah.
I certainly wouldn't count on it today. I mean, the market's, the market's attempted to trade lower all day today. The market's attempted to trade lower. We said early on when it widened out, we didn't get the elongation. I certainly wouldn't count on it today. Right now, all I see so far today is liquidation. Now you get a little short covering rally in here. But remember, this is pretty wide down here, so I'm not terribly impressed. I'm not going to be terribly impressed with the rally either. But I think to get overly excited about the downside today is really risky. It's really risky because there's been no real selling here today.
Right, and it just keeps widening out.
Yep.
I mean, it was interesting. It was too bad to, well, not too bad, but that was the fact that it kept trying to press lower and it just was having higher lows or couldn't even come close and it was widening out. That is, there was no real great trade location to get on that trade, but clearly it would make me real hesitant to go to the short side.
Yep.
I can't say I would have gotten long.
The ruling reason, one of the things that I talk about a lot is what I call ruling reason. My ruling reason this morning was when I pointed out, when we first started this webinar, I pointed out the difficulty initially in taking out the 8-period low. Then I talked about when the market got 4 wide up here. And I said if we really had anything major, it was unlikely that we're going to get 4 wide up here. We would have continued to elongate lower. That's been my ruling reason for today, along with the fact that I never had any real completion to the all-time high. Do I think this is high confidence trading environment? Absolutely not. Absolutely not. But remember somebody asked before about one time framing lower, and I said it looks more like balance. Now we did balance. Now if there's anything to the upside, we came out above the E-period high. Okay, so we got an upside breakout from the balance. If you went long with that upside breakout and you stops just a couple ticks below E, if there's anything here, you shouldn't come back. Even though it's fat down here, if there's anything here, you shouldn't come back to this range right in here. Remember the point of control is at 2053, so any trading up here is now, we talked about the fact that Julia pointed out you have the 45-degree line down here getting too long, and I came back and said, too short. I said, be careful, because the same thing can happen in the opposite direction with the point of control here. Now, this can still wide out. This is H period, so we're 1, 2, 3, 4, 7 wide here. We're 5 wide in H period. So as the day goes on, we could raise the point of control, but it's not particularly likely. It's a nothing day overall. I think the last comment I'm going to make, overall, all I saw today was a liquidating break, heavy heavy overnight news. Japanese, and they lowered the, they lowered the debt rating by 1. Soft numbers in China. I think there was probably some catch-all from the options expiration coming out on Saturday, and some assignments, and people got caught long. But I don't see any real selling in here today. I see liquidation, but I don't see any real selling in the market. And that's, not a particularly easy day. However, if you think about when we talked about overtrading, if you think about how do I stay out of overtrading today, I have not been convinced of the downside. I have not been convinced of the downside. I'm looking at the elongation. I'm looking about what's going on with the people I'm competing against in here. So the longer term money don't have any real completion to the longer term high. I don't think they were in here selling today, and they certainly could have been when we looked below last week's low. But early this morning when we went down, and particularly when we couldn't get elongation on the downside, to me, those are the things that help me keep a balance in the market and stay out of trouble. I mean, that's the biggest thing. There's no shame if you don't like a market, and I say this over and over again. There is no shame in not trading. Too many times, people are sitting there and they feel this terrible compulsion to trade. I got to do something. There's got to be something here I can do. If you are going out and you are looking for a trade, if you are going out and looking for a trade, more than likely it is not going to be a good trade. The good trades will just kind of pop up in front of you. The harder you look for a trade, the lower the odds that is a meaningful trade to engage in. Okay. What else do we can take a couple more questions as this market's trying to go higher. My point on this rally right now is I think the odds of much more on the upside should be fairly limited. That doesn't mean that you don't get you don't get more short covering, because the market could have gotten very short. But I don't think it's particularly high odds on here today. What else we got? Some other questions?
Right. This really, they kept selling at halfback. They kept trying to push it lower. It was widening out, and now we've seen a little short covering, but they gotten themselves in a little trouble. But it's still a very low confidence rotational day. I mean, it was a nice trade off the open when they couldn't fill the gap. Those are gap rules classic, and there was a nice trade on the bottom there. Not too hard to take early. But right now, this is where you can get into overtrading too, trying to make something happen when it's just not there, at least not yet.
Remember the comment early on, and I kept pointing out going exactly to halfback. When the market went exactly to halfback and before it broke. That's the sign. We talk about the importance of knowing who are you competing against. And when the market goes exactly to halfback and sells off, that's your weaker money. Then that's where the traps come in. And you can see they were selling, shorter term traders were selling every little rally today. They mechanically sold from halfback. I could feel down here when we were early into the webinar, we were trading down here, and I could really feel. In the old days, I could feel me getting caught short there in the old days. Say, oh, look at that price, look at that price. I could feel me getting caught short. And I'm looking down there this morning, and I know now I've learned about the structure and how to do other than price. Price would have misled me down there. Structure kept me out, but I could feel wanting to go short. The old habits were coming back. I could feel it. And it was a terrible trade. Anyhow, a final question or two before we wind this thing up?
No, that's good, Jim. Thank you. And just to remind people of the intensive starting January 20th, or to get involved now, you can start receiving reports today with the S&P reporting module and intraday chat comments that are going on now, and will continue up until the beginning of the intensive on January 20th.
Okay, and I will commit, if you really want to learn this stuff, get involved now, where you get all the chat comments leading into the January intensive. And if you have friends that really aren't that familiar with this, that gives them all of December and the first 2 or 3 weeks in January to assimilate enough knowledge to understand and appreciate the intensive. Once again, thank you all very, very much, and thank you, Julia.
Okay, great, Jim. Thank you very much, sir. And thank you, everyone, for being here. We'll get this recording uploaded for you. And if you didn't grab the slides or the reports, you can go to our website at this post and grab them. Okay, so thank you, everyone. Great day to all of you. And we'll see you next week, December 18th. I'm sorry, December 11th, I think, is our next webinar. So check it out at upcoming webinars at our site. And we'll see you then. Okay, thank you. Bye-bye.